Very good afternoon to all present here. Today, I, C.S. Surbhi Jain, on behalf of the Institute of Company Secretaries of India, extend a very warm welcome to our respected speaker, C.A. Kamal Garg, and all the members who have joined with us for an enlightening session on the topic Ways to Read and Understand Accounts of the Company as the 26th webinar of EEE 5.0 Master Knowledge Series. Members, before we will delve into the topic, we are delighted to announce that the applications are open for the 7th ICSI Best Secretarial Audit Report Award and 5th ICSI Best PCS Firm Award. And for further details about the award process and categorization, please visit the ICSI website. The last date to submit the application has been extended up to 6th October 2025. Now, coming to the topic of the day. The ability to read and understand the financial accounts of the company is a critical skill for us, the professionals, the company secretaries, as it forms the foundation for effective compliances, governance, and strategic advisory roles. Understanding accounts also empowers professionals to evaluate dividend declarations, managerial remuneration, related party transaction, borrowing, and investments from both a financial and a compliance perspectives. Today's webinar will focus on equipping the participants with the practical insights into analyzing the financial statements, such as balance sheet, profit and loss account, cash flow statements, while also understanding the accompanying notes and disclosures. This particular session will focus on how to correlate the financial information with the board report, auditor's observation, compliance checklist, enabling them to provide holistic guidance to the board and stakeholders. By strengthening their ability to decode the financial accounts, company secretaries can enhance their role as a trusted advisor in corporate decision making and ensure better accountability and transparency in governance. By learning how to read between the lines of the financial reports, our members will gain the ability to assess the solvency, profitability, liquidity, and overall financial discipline of the companies. And now, with this small brief on the today's topic, I would like to welcome eminent speaker C.A. Kamal Garg for the deliberation on the topic, and I would like to read his brief profile before our members. He is a fellow member of the Institute of Chartered Accountants of India and a first-class Commerce Baccalaureate from the Deen Dayal Upadhyay College, University of Delhi. He has also qualified post-qualification course on Diploma in Information System Audit conducted by ICAI. Besides this, he is also an insolvency professional and a qualified social auditor. He also had been a technical reviewer impaneled with FRRB ICAI. He has also addressed IFRS for the members of National Board of Accountants and Auditors, Tanzania, East Africa. He is also an author over a dozen of books which specifically contains IFRS and NDAS concepts and applications, Audit Trail, a practical guide, and many more. Now, we are privileged to have such an eminent speaker to deliberate on today's topic, and I'm confident that today's deliberation will enrich our understanding and equip with us with the updated knowledge. Once again, I welcome you all. Thank you for taking time to join us for today's session. And I request to post your queries in the Q&A box, which we will be taking either at the end of the session or during the session. Sir, over to you.
Mr. V, ma'am, good afternoon to all of you. I'm really glad to address participants in this afternoon, especially on a festive day, I must say, and happy Navratri to all of you. So before I deep dive into understanding of financial statements, most probably you must be having a question in the mind while being company secretaries, what we have to do with financial statements. Let me remove this kind of misconception at all if it is there. Company secretaries have a lot to do with financial statements. To give few instances, SEBI LODR is getting amended quite frequently when it comes to RPT, that is related party transactions. So financials are involved. Secondly, when director's report is prepared, one of the component is director's responsibility statement, section 134.5. In that director report, directors have to give a responsibility statement about true and fair view of financial statements, compliance of accounting standards, And when I say accounting standards, it's not only accounting standards, rather Ind AS as well. Ind AS stands for Indian Accounting Standard, which is the converged version of International Financial Reporting Standards. More importantly, being company secretaries, people are deep diving into compliance of CSR, corporate social responsibility. The audience may recall that for the purpose of CSR, profit needs to be computed as per Section 198 of Companies Act. When you see Section 198, a plethora of adjustment is there when it comes to net profit adjustment. Some items are added back, some items are deducted. If I make a pinpoint reference, one item is provision for bad and doubtful debts. Now, provision for bad and doubtful debts is not allowable expense when it comes to Section 198 of Companies Act. And hence, we need to understand distinction is there between provision for bad and doubtful debts and actual bad debts. Similarly, if I proceed further, for the purpose of managerial remuneration also, we need to compute profits. Again, section number 198 is applicable. Recently, I must share one experience which I had recently. You may recall under CSR, whatever amount is unspent, it needs to be deposited in a separate account with a bank. I'm raising this question to the House right now, which I will be answering after some moments. The question arises, if some unspent CSR funds are deposited in a scheduled bank, how it will be reflected in balance sheet, question number one, and how it will be reflected in cash flow statement, question number two. And these kind of questions are perhaps giving you the hint that how far financial statements and understanding thereof is mandatory. And I must say mandatory. Why? Because this needs to be captured in your reporting scenarios. If I proceed further, earning per share, a very big multiple to be understood, especially for listed companies. Most people don't even understand how to compute earning per share. For example, if I raise a question, when we compute EPS, earning per share, whether this EPS is computed by including preference share capital or not. So what we compute earning per share is equal to net profit after tax divided by number of outstanding weighted average shares. Now, when we say outstanding weighted average shares, what is the meaning of share here? Only equity or equity plus preference or equity plus convertible preference and so on. So we need to understand all these things. I'm sharing my screen and maybe this PPT which I will be sharing will be very helpful to you. Just give me a moment to share. Ma'am, can you confirm me? Is my PPT visible?
Yes, sir.
Okay. So this is the broader topic given to me, where to read and understand accounts of the company. I must congratulate first of all to the drafts person whoever chose this topic. If you see the words, one is read and second is understand. Most of the finance professionals perhaps read the accounts of the company and they don't understand. Understanding is quite critical over here, and this assumes special significance even for independent directors, because the audit committee chairperson must be able to read and understand the financial statements of the company. Now let me move one by one how this accounting aspect or financial statements are getting the statutory mandate. So for this purpose, we need to deep dive into Companies Act. So if you go into Companies Act, we have section number 129 subsection 1. Section 129 subsection 1 deals with financial statements. Now what does section 129(1) says? It says that the financial statement shall give a true and fair view of the state of affairs of the company or companies, comply with the accounting standards notified under section 133, and shall be in the form or forms as may be provided for different class or classes of companies in Schedule 3. So primarily section 129(1) deals with aspects of financial statements. Aspect number 1, the financial statement shall be in prescribed form. For example, Schedule 3 of the Companies Act. Aspect number 2, the financial statement must comply with the applicable accounting standards. This could be accounting standards or Indian accounting standards. Basically, I am saying companies accounting standard rules 2021 or companies Indian accounting standard rules 2015 as the case may be. Third aspect, the financial statements shall reflect true and fair view. Please focus on the words. The words are true and fair, not true and correct. Why true and fair? Because some material items must be captured, immaterial items may be ignored. And that's why the words are true and fair, not true and correct. So reasonable assurance is expected, absolute assurance is not expected. These three aspects are provided by section 129(1). Now, when financial statements are prepared, then somebody needs to attest them. And for this attestation function, the statutory mandate is given by section 143, subsection 3, clause E of the Companies Act. Section 143(3)(e) says, auditor shall report whether in his opinion the financial statements comply with the accounting standards. So what auditor will do? Auditor will go through the financial statements and apply some audit procedures, and then will come up with the opinion as to whether the financial statements are complying with accounting standards or not, are they reflecting true and fair view or not. This is the basic statutory mandate which is contained in Companies Act. Now, before I proceed further, let me ask you a question. I'm typing the question on the screen. Please try to answer. Section 129 states that financial statements shall be in the form as prescribed. And what is this prescription? The prescription is Schedule 3. So my question to the House is, and I would request the moderator if somebody can pass upon the answers. Question
Yes,
is whether Schedule 3 deals with cash flow statement or not. That's my question. And I must tell you, when I say companies to comply with Schedule 3, companies here means the normal companies like manufacturing companies, trading companies. This will not include banking companies, because for them, Banking Regulation Act is there. This will not include insurance companies, because for them, the insurance laws are there. And hence, if I come to the normal model, let us say a manufacturing company is there, the question for the House is whether Schedule 3 deals with cash flow statement or not.
we are yet to receive the responses of the members. I request members to kindly give their responses in the query box so that I can read out such responses.
So you may keep on thinking. Meanwhile, let me spill the beans in a very brief fashion. The expression financial statement is defined by the law, section number 2, clause 40 of Companies Act. When you refer section 2, clause 40 of Companies Act, the definition of financial statement moves like this. Financial statement in relation to a company includes a balance sheet as at the end of financial year, a profit and loss account for the financial year, cash flow statement for the financial year, a statement of changes in equity if applicable. This statement of changes in equity is prepared only by those companies who are complying with the Indian accounting standards. So those who are into accounting standards domain, they are not supposed to prepare and present statement of changes in equity. And last one is explanatory notes, that is notes to accounts. Now, keeping this definition given by section 2, clause 40 in mind, what would be the answer of the audience regarding this question, whether Schedule 3 deals with cash flow statement or not?
So we have mixed responses. 3-4 participants are saying yes, and some of them are saying no.
Okay, the correct answer is no. But you need to understand, I'm typing something on screen, you may take a note of it. It's a caution for you. Number 1, Schedule 3 do not prescribe any presentation format for cash flow statement. Then who prescribes? The correct answer is whether it is Accounting Standard 3, or if it is Ind AS, then Ind AS 7, which prescribes the format for cash flow statement. I have seen some secretarial audit reports also. I have seen some director's report also, even auditor's report as well, where somehow this line is, if this sentence is going on, the cash flow statement is prepared and presented as per Schedule 3. But the fact is, Schedule 3 is not dealing with cash flow statement. The second thing which we need to limelight over here is, if a company complies Companies AS rules 2021 then statement of changes in equity need not be prepared. But if company complies with company's Ind AS rules 2015, then statement of changes in equity need to be prepared. So if I go back, this is what section 2 plus 40 of Companies Act says. You have to be careful on two aspects, two components of financial statements. One is cash flow statement, and second is statement of changes in equity. If you see the expression, the words are statement of changes in equity if applicable. So we need to understand what is the meaning of it applicable, if applicable. The correct answer is this screen. Statement of changes in equity is applicable on a company only and only if that company complies with company's Indian accounting standards or Ind AS rules 2015. Second thing which I must emphasize again and again, cash flow statement is a statement and a component of financial statements, but it is not mandated by Schedule 3. It is mandated by virtue of Accounting Standard 3 or Ind AS 7 as the case may be. Now, next leg of discussion is how to read financial reports. For this purpose, let us deep dive one by one. First thing is, what we need to understand is the purpose of financial statements. So please understand, as we have English as a language, Hindi as a language, Tamil as a language, Punjabi as a language, to communicate. Same way, the language of business is accounting. And for this purpose, the language of accounting could be having a uniform status. That uniform status is being brought in by accounting standards or Indian accounting standards. So accounting is the business language. How you will communicate to the stakeholders like investors, like owners, like directors, and so on. For this purpose, accounting is the business language. So what we need to understand, what is the purpose of financial statements? The purpose of financial statements is to show where the company money is coming from and where it went and what was the situation at a particular point in time. So while board of directors are not responsible for producing the accounting documents, so books of accounts need not be produced to each and every stakeholder, but the board of directors are required to approve them. So they must be able to decipher them and detect potential problems. So in this very section which we are assembling today, we will describe the main elements of corporate financial reports and how to analyze them in a meaningful way. The main elements, as I told you, will include balance sheet, statement of profit and loss, cash flow statement, and notes to account. So let us discuss these elements one by one. First is balance sheet. What is balance sheet primarily? Balance sheet summarizes what a company owns and owes. What a company owns and owes at a specific point in time. Now, what is the meaning of specific point in time? For example, the balance sheet is prepared as at 31st March 2025. So this as at 31st March 2025 signifies specific point in time. Balance sheet provides detailed information about company's assets, company's liabilities, company's assets, company's liabilities, and shareholder equity at the end of reporting period. So when I say equity, equity will also include reserves. The balance sheet does not show all the flows into or out of the accounts during the period. The following formula is most fundamental principle of accounting and reflect double entry accounting as the modern process for ensuring consistency of accounting. What is the formula? Liabilities plus equity equal to assets. So you may recall when we were students, we always used to say balance sheet must be tallied. When we say balance sheet must be tallied, it means that assets side of balance sheet must be equal to equity plus liabilities side on the other side. In other words, what I'm trying to convey, the right-hand side of the balance sheet reflects what organization invests in, that is assets, and the left-hand side of the balance sheet reflects how it finances itself to fund these assets, that is the liabilities, notably debt and equity. Although I'm using the word right-hand side and left-hand side because of this equation, but when you refer Schedule 3, there is nothing like right-hand side or left-hand side. It is a vertical format, and hence this is only for the sake of academic discussion which we are having now. Precaution. When you see the balance sheet, what we need to be careful about, overvaluation of assets and undervaluation of liabilities. Overvaluation of assets and undervaluation of liabilities are classical elements of financial fraud. and board members should pay particular attention to these undervaluation or overvaluation of assets or liabilities as the case may be. So keep this statement in mind. We will discuss few case studies on this aspect as we will move forward in some moment. Next is income statement. Income statement is also called as profit and loss statement, and it shows how much money a company earned and spent over a specific period. Just see here the words are over a specific period, and in balance sheet it was at a given point of time. So whenever you see P&L account, what we write, statement of profit and loss for the year ending on 31st March 2025. So for the year means in the entire gamut of a given financial year, that is over a specific period, what the company earned and what the company spent. Now, generally, these technical terms are used like top line and bottom line. What is the meaning of top line and bottom line? Sometimes people confuse top line with net profit. No, it's not like that. Let us understand what is top line and bottom line. At the top of the P&L statement or income statement, revenue from sale of goods or services is called as top line. Next comes various cost or operating expenses which are deducted from the income to arrive at the net income or net profit, and this net income or net profit is called as bottom line. So revenue is top line and net profit is bottom line. Now in the P&L statement or income statement, there are certain non-cash items also called as notional amounts. Now these notional amounts or non-cash items, what they signify? They signify like depreciation, provision for bad debts, impairment loss. All these are non-cash or notional items. Now the bottom line does not necessarily correspond to the actual amount of money made, because some costs such as depreciation that do not affect the cash position directly. I must tell you here, and everybody must take a note of this remark, P&L statement does not mean that the amount which is earned has actually been received also, because accounting moves on accrual system and the goods must have been sold, but money may not have been received. So in this case, what will happen? The revenue side will be up, cash will not be up, rather trade receivables will be up. So what we need to understand, the P&L account always will not match with cash flow statement, because it will be a kind of discussion of profitability versus liquidity. Additionally, what we need to understand, some items on the balance sheet are not reflected in the income statement, even though they affect the cash position. This includes working capital elements such as inventories, accounts payable, that is amounts owed to suppliers, and accounts receivable, that is amounts due by customers. Quite obviously, as I told you, if the goods are sold on credit, the revenue will be booked in P&L statement, but there will be another item, that is trade receivable. It will not come into P&L, rather it will affect your balance sheet. Quite obviously, it is based upon double entry book system. As far as cash flow statement. Now, what is cash flow statement signifying? It reports a company's inflows and outflows of cash. It shows whether the company stayed positive or negative. Company stayed positive or negative based on cash flow exchanges with other companies over a specific period. This is important because a company needs to have cash on hand to pay its expenses. It is crucial to understand that profits do not correspond to cash. I said it earlier also. It is crucial to understand that profits do not correspond to cash. Indeed, depreciation affects profits, but not cash, while working capital or capital expenditure affect cash, but not profits directly. So what we need to understand, a good approximation of cash flow is to add back depreciation and amortization to the profits and to subtract the changes in working capital and capital expenditure. Basically, what I'm trying to say, profit plus or minus non-cash adjustments like depreciation will give you cash flow, and hence cash flow needs to be distinguished from earning capacity or spending capacity of the company. Let me ask you a question here again. From where I started, let me ask the question over here. CSR unspent account. So let us assume the company is RST Private Limited. CSR is applicable. Rupees 1.5 crores were deposited in a scheduled bank words, unspent CSR account. Question is where it will be shown in cash flow statement and balance sheet. And I don't want the answer as it will be shown below the heading assets, but obviously it is an asset. But where it will be shown in cash flow statement and balance sheet. So CSR unspent account is not merely about finding and filling this form CSR. Form CSR filling is the different aspect. It's the kind of compliance aspect. But what about financial statement presentation aspect?
Sir, I will share the answers with you once I'll receive the same.
I must give the answer in the interest of time. So it will be shown as earmarked balances. So in the balance sheet also, in the cash flow statement also, it will come below the heading earmarked balances of cash. Why earmarked balances? Because this amount is meant only for CSR purposes and nothing more than that. And that's why below the heading cash and bank balance in the balance sheet, as well as cash flow statement, it will appear as earmarked balances. Obviously, we will describe for what purpose it is earmarked. The purpose is CSR. Ready, move forward. In addition to what I said about cash flow statement, what we need to understand, whereas an income statement or profit and loss statement indicates whether a company made a profit or loss, a cash flow statement reveals whether it generated cash or not. And I must tell you, cash flow statement is a very big indicator, about the appropriateness or inappropriateness of going concern assumption. I repeat, cash flow statement is a very big indicator about the appropriateness or inappropriateness of going concern assumption. Generally, people focus only on profitability. Profitability is okay, but if profits are there but cash is not there, then the lifeblood is gone. And for this very purpose, cash flow statement must be examined and evaluated very carefully. The cash flow statement shows changes over time and absolute amounts at a point in time, and is thus a strong indicator of the health of organization. Now, what the company secretaries or board members should be careful about, they should scrutinize cash flow statements carefully because they correct the accounting distortions of income statements to provide a more realistic measure of whether the organization is making money. And quite obviously, as I said, profit is accounted for on accrual basis. Cash flow is prepared on actual receipt or actual payment basis. And cash is the lifeblood. So there could be huge profit, but lower cash flows, it is a sign of inappropriateness of going concern assumption. Now, there are certain common observations which each finance professional, be CA, be CS, must be watchful for. So I'm giving certain questions to be discussed. While preparing the financial statements and while framing the accounting policies, Company X has used the following words. You must have seen financial statements. In notes to accounts, there were certain policies. One of the policy drafted by the company about inventory is as follows. What is the policy? You can see the words which are written in red. Inventories are valued using weighted average cost method or specific identification method as applicable. So this is the policy which was there in the notes to accounts of Company X. So you take 30 seconds to reply me back whether this accounting policy is correct or incorrect. Whether this accounting policy is correct or incorrect. So the accounting policy is incorrect, people. Why this is incorrect? Let us try to understand. As I told you, we have either the accounting standards or Ind AS, and then we have Schedule 3. So why this policy is incorrect? See the word inventories. Now, inventories is a blanket word. And what the law requires, you have to be specific for each class of inventory. What Ind AS 2, Ind AS 1, read with accounting standards, both are same, but they say to ensure proper understanding of financial statements, it is necessary that all significant accounting policies adopted in preparation and presentation of financial statements should be disclosed. So while here the company disclosed the financial statements, but it was not complying with the requirements of Schedule 3 and Ind AS 2. Schedule 3 as well as Ind AS 2, but it says the financial statements, FSM's financial statements, the financial statement should disclose the accounting policies adopted in measuring inventories, including the cost formula used. Now, in this policy, the cost formula is properly given. That is weighted average cost or specific identification method. But now what happened, this policy is not given by each classification. So let us try to understand, including the cost formula used, the total carrying amount of inventories and its classification appropriate to the enterprise. So what was the company X supposed to do in this question? Company X was supposed to give the accounting policy respectively for these each classes of inventories. Raw material, separate policy. Work in progress, separate policy, and so on. So what it was supposed to do, it must have told to the users that raw materials are valued on weighted average method. Work in progress is valued, let us say, on again FIFO method, and so on. Schedule 3 also says not only this classification is required, but in addition to this classification, Schedule 3 says in addition to this classification, the company need to give the mode of valuation. So mode of valuation also need to be stated. Now, what is the mode of valuation? The mode of valuation is inventories are valued at lower of cost or NRV. NRV means net realizable value. So that mode also need to be indicated and disclosed. And more importantly, goods in transit for each category to be specified separately. Now, goods in transit also need to be specified. So there could be a scenario that on 31st March 2025, certain goods which you ordered to be brought into Delhi from Chennai, they were on the way, on the highway. So these were not received by the Delhi head office. What to do? So for Delhi head office, such transit will be taken as inventory provided the risk and rewards of that inventory has already been transferred to the Delhi office. So depending upon whether risk and rewards about the goods being purchased are with you or not, you will take a call whether these goods are in transit for you or whether these goods in transit are for the sellers. Take this question. There was a company, and what the company did in the notes to accounts, the company has stated in its financial statements this policy. Revenue has been recognized in accordance with Ind AS 115. The correct number is 115. Or if you go to AS9, then AS9. So what do they say? Entity has recognized the revenue as per Ind AS 115 or AS9. Whether this accounting policy disclosure is correct? Can we simply write that revenue has been accounted for as per Ind AS 115 or AS9? Is it correct? Answer is no. Why? Because this is a blanket policy. This is a blanket policy. What is the requirement? The requirement is the policy for revenue recognition must be given for each item of revenue, each item of income. That is, the entity should separately disclose the accounting policy for different type of incomes as explained in Ind AS 9, for example, sales, royalty, dividend, interest. In case of other types of incomes, an explanation pertaining to method of recognizing revenue should be explained in the accounting policy. So whatever P&L statement is reflecting sale of goods, sale of services, interest income, dividend income, royalty income, etc., etc. Whatever incomes are there, for each income, each type of income, you have to specify your accounting policy. You cannot write like this, all the incomes are recognized as per Ind AS or AS as the case. I mean, this is not a correct scenario of disclosure. The correct scenario is you have to give disclosure for each type of income. Issue number 3. In the books of a leading real estate developer, say X, there are residential complexes which are constructed but not sold at the end of financial year. X has shown them as inventory. For the purpose of valuation of inventory of residential complexes, it has revalued cost of land on which those complexes are constructed. Ultimately, X has revalued cost of inventory of complexes. So what happened? Let me give you a numerical example over here. Perhaps this will be helpful. What happened? Let us say the company is RST Private Limited, and it is into real estate. It has plot of land, for onward sale. It also has unsold flats. The cost of land is rupees 100 crores. The cost of unsold flats is rupees, let us say, 1000 crores. The market value of land after deducting, or I should rather say market value after deducting cost of sale. The market value of such land is rupees 250 crores. And unsold flats is rupees 100. The company passed the following journal entry. What is journal entry? Let me show you. Just give me a moment. The journal entry is unsold flats account debit 500 CR plot of land account debit 150 CR to revaluation reserve 650 CR. So you take a moment or so and do tell me whether this journal entry is correct as per the applicable accounting standards. Is the journal entry, is this treatment correct? So first of all, but we need to understand this land is an inventory for RST Private Limited. Unsold flats also inventory for RST Private Limited, and hence the right treatment as per AS2 or Ind AS2. What is the right treatment? Value the inventory as per cost or NRV, whichever is lower. So what is the significance here? Revaluation of inventory is not allowed. What is NRV? NRV is market value less cost of selling the inventory. I believe you must have understood this scenario. What is the wrong thing which company did? The company being into real estate activities and they're carrying the inventory of land plot and unsold flats. So ideally, they should not have revalued the inventory figures, but they did the revalued, and hence this company is wrong. This revaluation reserve is not allowed. And that's why this case study was there. Whether inventory valuation policy of X is correct or not, answer is no. Why? This is the answer. There is no provision given under Ind AS 2 or AS2 which deals with valuation inventories to revalue cost of items of inventory. As well, as per Ind AS 2, inventory should be valued at lower of cost and net lesser value. Therefore, in respect of both aspects, inventory valuation policy is wrong. And you may find this kind of a wrong scenario in most of your experiences, but we need to always remember, even though it's a plot of land in respect of a real estate company, if it is accounted for as an inventory, then no revaluation is permitted. I repeat, no revaluation is permitted for the plot of land, provided this plot of land is not considered as property, plant, and equipment. If it is inventory, then it will be valued at lower of cost or NRV only. That we need to be very careful about. Let me give you one more case study. Consider this case study. In the cash flow statement, an entity has categorized its cash flows during a particular period into 4 categories, which are cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, and cash flow from other activities. The question is whether the entity has categorized its cash flows correctly as per Ind AS 7 cash flow statement. Whether this categorization is correct. Any answer? So please understand, when you refer Ind AS 7 dealing with cash flow statement or accounting standard 3 dealing with cash flow statement, but these standards say that cash flow statement can reflect only 3 activities. I repeat, cash flow statement can reflect only 3 activities. Number 1, cash inflow or outflow from operating activities. Number 2, cash inflow or outflow from financing activities. And number 3, cash inflow or outflow from investing activities. Other activities are not allowed. So if I show you a tentative or a kind of exemplary cash flow statement, just see this cash flow statement. This is the cash flow statement. We will start from net profit before tax, let us say rupees 1,000. Then we will make adjustments for non-cash items and working capital changes. Let us say this is minus 100. This will give you item A, cash from operating activities, 900. Then let us assume the company invested in some long-term assets or invested in property, plant, and equipment, or has given long-term advances or loans to some other company. Then it will be called as cash from investment activities. So this will, let us assume, is rupees 500. Then cash from financing activities. The company borrowed some money, company issued some share capital. This is nothing but financing activities. So let us say it is minus 200. Now, the aggregate of all these elements or components will give you net increase in cash balance or cash and cash equivalents. Let us say it is 1200. Now this 1200 should match with the difference of opening cash balance minus closing cash balance. Now opening cash balance is 1800 and closing cash balance is 3100. The difference of these two is 1300. Now this 1300 is not matching with 1200. So it means that there is some discrepancy in cash flow statement. Now what happened? Let us assume this way. There was an accountant. He was trying to prepare cash flow statement and he tried really hard. He struggled a lot, but he was not able to identify the difference of rupees 100 in between this 1200 and 1300. So what that accountant did, in order to finalize cash flow statement, because due dates were approaching, the board meeting was approaching, what it did, the accountant inserted one more row in the cash flow statement, and the row was cash from other activities. Now when the cash from other activities were inserted, what he did, he punched the figure of rupees 100. By punching this rupees 100 figure, what will happen? Net changes in cash and cash equivalents will be 1300. Now this 1300 will match with the difference of this opening cash balance and closing cash balance. So what will happen? The cash flow statement will tally, will match, but it will be a poor cash flow statement because there is no concept of cash from other activities in cash flow statement. So each one of the listener must be very careful. This could be a red flag. This could be a sign that cash flow statement is nothing but a hanky-panky business. So you need to be watchful and watchful for any such kind of element, cash from other activities, because this is not allowed as per accounting standard 3 or Ind AS 7 as the case may be. Next question. There is a company X Limited, and it has disclosed in the financial statements its accounting policy in respect of creation of provision for doubtful debts as follows. So there was a company, and the policy for provision for bad and doubtful debts is moving like this. Provision for bad and doubtful debts, if any, would be made at appropriate time. So the company says in notes to accounts that we will create provision at appropriate time. Now, question is whether this accounting policy regarding provision for doubtful debts is correct or not, because the company says we will create the provision whenever there will be appropriate time. Is this correct policy or not? Yes, any answer? Is this correct policy or not? Any answer? So please understand the policy is incorrect. The very big reason is what they say, provision will be made at appropriate time. So this gives a sense of uncertainty, indecisiveness. What is that appropriate time? It is not being disclosed. And this is not complying with the applicable financial reporting framework. So when I move to discussion, be it AS or be it Ind AS, what AS and Ind AS rules require in respect of a contingency, the uncertainties which may affect the future outcome should be disclosed in financial statements. Just see the words very carefully. In respect of a contingency, you know what is the contingency here? The contingency is the probability that doubtful debts may take place. So these kind of uncertainties which may affect future outcome should be disclosed in financial statements. So entity should disclose the event or time when provision for contingency of non-recoverability of debts should be made. In the given case, that is this company X Limited, it has disclosed that provision for doubtful debts, if any, would be made at appropriate time. It should disclose the event or time. So what is the correct scenario? The company should disclose the event or time when provision would be made. And hence, as I said, this policy is wrong and is contrary to the principles of financial reporting framework that is guided by Ind AS 1 and Ind AS 8. I believe this point is clear to each one of you. And you may find this kind of policy in plenty in real world. Next issue. A company is engaged in the business of setting up hydropower plant, generating and selling hydropower. The company receives revenue and government support through checks. As per company's current accounting policy, as at 31st March, let us say 2025, that is the balance sheet date, checks or drafts which are received by 31st March, but dated after 31st March, popularly called as post-dated check, but on or before, let us say 15th April, are accounted for as checks in hand for the year ending on 31st March, let us say 2025. So what happened in this case, let us take this way. On 31st March, that is balance sheet date, the company received some post-dated checks. Question arises whether these post-dated checks can be accounted for as assets, as checks in hand on 31st March 2025. Yes or no? And whatever your answer is yes or no, with the reasons. Yes, any answer? So for this purpose, let me spill the beans. The policy which company is adopting is wrong. Why it is wrong? Let us try to understand. When we refer the framework for preparation and presentation of financial statements issued by Institute of Chartered Accountants of India, what is the definition of asset? Asset is a resource controlled by the enterprise as a result of past events from which economic benefits are expected to flow to the enterprise. Hence, checks in hand to be considered as assets as on the balance sheet date should be in possession. I repeat, should be in possession, and number second, should be in control of the company. Should be in control of the company in such a way that these can be used based on company's directive. Therefore, the company's policy of treating such check or drafts which are received by 31st March but dated after 31st March but on or before 15th April as checks in hand is not correct. But checks should be accounted in subsequent accounting period only. I repeat, why this policy is incorrect? Because although you have checks in hand, But can you use these checks? Can you use these checks on 31st March? Answer is no. Because you cannot use these checks on 31st March, it will not be deemed that these are in your control. And because these are not in your control, these will not be classifiable as an asset. And hence, the policy adopted by the company to treat checks in hand as an asset is wrong policy. Next issue. A company, say Company Y Limited, is engaged in the business of providing works contract service. Few days back, it had received a notice from tax authority raising a demand of tax on works contract service provided by 4 rupees XYZ. Y Limited paid this demand, and in the books, such payment is being recorded as exceptional expenditure. So tax notice was received by Y Limited, and tax was paid under that notice. And what the company did, company treated such tax payment as exceptional expenditure. Question is whether payment of tax demand raised by the taxation authority can be recognized as exceptional item. The payment of tax under demand notice of income tax department, is it a kind of exceptional item or exceptional expenditure? Is it exceptional? People, please understand, when it comes to SEBI LODR, LODR stands for listing obligations and disclosure requirements. When it comes to SEBI LODR, this payment of tax may be a material event, may be, I am emphasizing, may be a material event under regulation 3030 of SEBI LODR. But simply because it may be material under SEBI LODR, it is not exceptional for the purpose of accounting standard, because this demand is quite normal to any business house. And for that reason, what we need to remember, this tax demand shall not be considered as exceptional item. So what the law says when it comes to Ind AS rules, as per Ind AS 1, read with Ind AS 8, exceptional items are income or expenses that arise from events or transactions that are clearly distinct from ordinary activities of the enterprise and therefore are not expected to recur frequently or regularly. In the given case, what happened? Providing works contract service is ordinary activity. Thus, tax paid either pursuant to the demand raised by the tax authority or otherwise in this connection is also a part of ordinary activity of Y Limited. Hence, recognizing these payments as exceptional items is against the spirit of Ind AS. When I say Ind AS here means Ind AS 1 read with Ind AS 8. Next issue. You may recall that in Income Tax Act we have sections 234B and 234C which deal with payment of interest for default in payment of advance tax installments. Now, this question is in that context. So what happened? Short payment of advance tax installments invites levy of interest under section 234B and 234C of Income Tax Act. The company has the following questions in this regard. Should the company classify interest under section 234B and 234C as tax expense in the financial statements? And number second, is such interest an exceptional item in accordance with Ind AS? So whatever interest payment is made under Income Tax Act because of advance tax default, whether this interest payment is a tax expense, yes or no? And number second, whether such payment is exceptional item or not. Well, people, please understand, let me give the answer over here. First is interest on advance tax is a finance cost and not tax expense. For this purpose, you have to refer Ind AS 12 or AS 22 plus guidance note on Schedule 3. Second is such interest is not exceptional item. Why? Because payment of advance tax is inherent compliance for any business. So neither this interest is exceptional item nor this interest is tax expense. Tax expense over here is nothing but a finance cost. So in the P&L statement, we have a separate line item, finance cost. Below this line item, it will be reflected as interest on advance. Take this question. A company A Limited has prepared its financial statements. In the financial statement, foreign exchange gain on sales transactions like gain on subsequent recognition of closing foreign debtors have included in sales revenue, but other exchange gains have disclosed as other income. Whether above treatment is correct? So let me tell you what happened over here. Try to understand through an example. Let us assume the company is RST Private Limited. It exported goods worth rupees 100. I'm taking hypothetical figures. And the goods were sold on credit. So bill was made in USD and I'm giving the equivalent value. Equivalent rupee value is rupees 100. Now what happened? As on 31st March 2025, there was an exchange gain of rupees 10. Now, when these goods were sold on credit, the journal entry was trade receivables account debit rupees 100 to sale of goods account rupees 100. Now, when on 31st March there was the exchange gain of rupees 10, the journal entry was like this: trade receivables account debit rupees 10 to sales of goods account rupees 10. Question to the house is whether this journal entry on 31st March 2025 is correct or incorrect. Whether this journal entry is correct or incorrect. Yes, any answer? So please understand this entry is wrong. This entry is not allowed. The proper entry will be, let me tell you, to forex gain P&L account. So this amount will go into P&L as forex gain, and this entry will not be passed. So basically, what is the accounting standard saying? Accounting standard says whatever foreign exchange gain or loss is there, that shall not be adjusted with sales of goods. Rather, it shall be adjusted. It shall be adjusted and recognized with P&L statement, be it income or be it expense or loss, as foreign exchange gain or loss. And that is what this question is dealing with. So what is the learning? The learning is Ind AS 21 when it comes to Ind AS, and accounting standard 11 when it comes to accounting standard rules. What do they provide? They provide that exchange differences arising on settlement of monetary items, here it is trade receivable as monetary item, or on subsequent recognition of monetary items at the end of accounting period, they should be recognized as income or expense. Thus, A Limited is correct in treatment of exchange gains other than exchange gains on sales transaction. Exchange gains on sales transactions should not be included in sales revenue. It should be included in other income. If you see this journal entry, I struck off sales of goods and I recognize this rupees 10 as other income with the ledger name foreign exchange gain. So this will travel into P&L obviously, but not below the heading sales of goods, rather below the heading forex gain. Take this question. A company C Limited entered into transactions with various parties which are related, including key management personnel and their relatives. In the financial statement of the company, it has disclosed these transactions by dividing parties into three categories, that is KMP, relatives of KMP, and other related parties. Question for the House is whether this disclosure is correct or incorrect. Can you see any violation in this disclosure? Let's see the words other parties. This other is nowhere permitted under India's or AS. The correct answer is, if you refer India's 24 or Accounting Standard 18, what they say, if there have been transactions with related parties during the existence of related party relationship, the entity should disclose a description of the relationship between the parties. In the instant case, C Limited has disclosed a description of relationship only in case of transactions with KMP and the relatives, but has not disclosed the type of relationship in case of transactions with other related parties. Therefore, RPT in this case have not been properly disclosed. So other parties is not a proper disclosure. You have to specify the nature of relationship, else it is the contravention of Index 24 or Accounting Standard 18 as the case may be. So let me ask you a question over here. Let us assume there is a company RST Limited. It has Mr. X as independent director. Sitting fees of rupees, let us say 100, is paid to Mr. X. Question is, where such sitting fees will be shown in P&L account. Well, let me give you some options. Option number 1, legal and professional charges. Employee benefit expenses, miscellaneous expenses, office expenses. Yes. Any answer? So let me tell you, the correct answer is, so we have Ind AS 24. It deals with related parties. As per Ind AS 24, independent directors are KMPs. Hence, sitting fees paid to them will be reflected under employee benefit expenses. Let me write one more line which I somehow skipped. So as per Index 24, Index 24 says independent directors are KMPs, and as per Ind AS 19, so we have one more standard, that is Ind AS 19. It deals with employee benefits. So hence sitting fees paid to them will be reflected. Why under employee benefit? Because as per Ind AS 19, independent directors are employees. So by virtue of Ind AS 19, it will be shown under employee benefit expense. But at the same time, in notes, the same amount will be explained as paid to KM. So people, what we need to understand when it comes to companies at section 2 clause 51, independent directors are not KMPs. But for the purpose of Ind AS 24, they are considered as KMPs. So that's why they are related parties. So under Companies Act, independent directors are not parties related, but under Ind AS, they're considered as parties related because they're considered as KMPs. Number one. Number second, when it comes to employee benefits, for the purpose of Ind AS 19, which deals with employee benefits, independent directors are considered as employees. And that's why sitting fees paid to them will be reflected below employee benefit expense. And now what you need to consider about is certain companies, some companies are showing it in legal and professional charges. It is incorrect treatment. So sitting fees paid to independent directors will come in employee benefit expenses. Let us take this question on earning per share. So this question is about earning per share. So I will not read the theory because theory will be a bit confusing. Let us take a practical case. So we have a company, let us say RST Limited. On 1st April 2024, its equity shares were 10,000. On 1st October 2024, a fresh issue of 1,000 shares were made. As a result of which, as on 31st March 2025, the outstanding equity shares were 11,000 shares. Let us assume the profit after tax, that is PAT, of RST Limited is 1,10,000. Question arises whether basic earning per share will be rupees 10 or not. Basic earning per share here is calculated by dividing PAT with number of shares 11,000. Answer is no. This is not the correct treatment of computing EPS. The correct way of computing EPS is to compute weighted average number of equity shares. And how this will be computed? 10,000 multiplied by 12 by 12 because 10,000 shares remained outstanding entirely throughout the year. Then 1,000 multiplied by 6 divided by 12. That is, these 1,000 new shares, they remained outstanding for only 6 months. This will give you weighted average number of equity shares outstanding as on balance sheet date. Total is 10,500 number of shares. So basic earning per share will be, corrected basic earning per share will be profit after tax, that is 1,10,000 divided by 10,500 number of shares as weighted average. Correct answer is 10.48 rupees. And let me go back to the initial question which I asked you, whether preference shares or convertible preference shares will be considered to compute weighted average number of shares. Answer is no. Only equity shares are considered for the purpose of computing basic earning per share. I repeat, only equity shares are considered for the purpose of computing basic earning per share. Preference shares are not considered. I repeat, preference shares are not considered for the purpose of computing weighted average number of shares. I believe this point is clear to each one. And that's why what the standard says. Ind AS 33 says that basic earning per share should be calculated by dividing net profit for the period attributable to equity shareholders by weighted average number of equity shares outstanding during the period. An entity should use weighted average number of equity shares outstanding during the period. It cannot use the number of equity shares outstanding either at the beginning or at the end of year, except when there is no increase or decrease in the equity share capital. In this question, that's why we computed weighted average number of equity shares depending upon the incremental stage of equity issue. Next question. So we have cash flow statement. We have Ind AS 7 or AS3 dealing with the cash flow statement. Now here is a conflict. Accounting standard number 3 or Ind AS number 7. In common, what they say, deposits with original maturity of 3 months or less. Deposits with original maturity of 3 months or less should be classified as cash equivalents. Bank balances held as margin money or security against borrowings are hence neither in the nature of demand deposits nor readily available for use by the company, and accordingly they do not meet the definition of cash equivalents. But when it comes to Schedule 3, Schedule 3 defines cash and cash equivalents to say that cash and cash equivalents comprises balances with banks held as margin money and security against borrowings, guarantees, etc., and bank deposits with more than 12 months maturity. Now, audience need to focus upon the initial words. Balances with banks held as margin money. So, Schedule 3 says balances held with banks as margin money is also a cash equivalent. Question arises, AS3 says or Ind AS 7 says these are not cash equivalents, but Schedule 3 says it's cash equivalent. What to do? Any answer? For this purpose, we have guidance note in Schedule 3. Now, guidance note in Schedule 3 says, just see, this is the question which I took from Schedule 3 guidance note issued by ICI. How to deal with this conflict? So, guidance note says Ind AS will prevail over Schedule 3. Quite obviously, what is Ind AS, you know very well. And hence, the guidance note says because Ind AS will prevail over Schedule 3, companies shall make necessary modifications in the financial statements. Accordingly, this conflict should be resolved by changing the caption. So in balance sheet, you'll find a caption, cash and cash equivalents. Now, what guidance note says, you should change the caption, cash and cash equivalents to cash and bank balances. And then you will give two subheadings to cash and bank balances heading. Number one, cash and cash equivalents, and other one is bank balances. So new heading will be cash and bank balance. Two subheadings will be cash and cash equivalents and bank balances as other bank balances. Then what you will do? The former should include, that is the cash and cash equivalents should include only those items that constitute cash and cash equivalents defined in accordance with Ind AS and note of Schedule 3, while the remaining line items may be included in the latter subheading. Then my question, those bank deposits which are held as margin will be reflected in other bank balance. I believe this point is also clear to each one of you. Next issue. The special economic zone, which is, let us say, run by a company A Limited, and it is engaged in the business of manufacturing of parts of laptops. It imports raw materials for manufacturing of parts and exports almost all units it produces. For the purpose of recording the import and export transactions in the reporting currency, let us say Indian rupees, the company uses a prefixed exchange rate. So company were exporting in USD terms and company's presentation currency is Indian rupees. So what company did? It fixed exchange rate as on the first day of the financial year. So what happened? The company exporting in USD terms. Now USD needs to be converted into Indian rupees. For that conversion rate, what the company decided? The company resolved whatever dollar rupee rate will be existing on 1st April each year, the same rate will be used all throughout the year for conversion of USD transactions into Indian rupees. Question is whether foreign currency transactions can be recognized at a prefixed exchange rate. Can it be done? Yes, any answer? Can it be done? So answer is no. Why? Just see, AS 11 or Ind AS 21, you may refer any of the accounting standard, they are common in this aspect, but they say a foreign currency transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency at the date of transaction. At the date of transaction. Now, I believe the answer is quite obvious. Therefore, A Limited should record the import and export transactions at the rate prevailing on the date of transaction. It cannot use any prefixed rate. Prefixed rates are not allowed. Date of transaction is important and the rate prevailing on that date shall be used. Next issue. A company, say company X, is engaged in the business of manufacturing and selling of tea. During the previous financial year, it had received subsidy on fertilizers from the government. While preparing financial statements for the previous year, X has clubbed the amount of subsidy with revenue of that year. So subsidy was accounted for as revenue of that year. Is this accounting treatment correct? For government subsidy, answer is no. So we have accounting standard 12 when it comes to companies accounting standard rules, or Ind AS 20 when it comes to companies Indian accounting standard rules. Both are common in that aspect, but they say government grants related to revenue should be recognized on systematic basis in the profit and loss statement over the periods necessary to match them with related costs which they are intended to compensate. That is, such grants should be either shown as other income or they may be deducted directly from the associated expense. Hence, Company X should disclose the subsidy on fertilizers as other income, or should deduct it, net of it from the amount of expenditure. That means this government grant cannot be accounted for as sales revenue. It will be either as other income or it will be directly deducted from the related expense. I believe this question is also clear to each one of you. Next question. A company, say Company A Limited, has certain investments which includes both current and non-current investments. At the end of the year, the management of A Limited identified decline in the value of current and non-current investment, which was of other than temporary nature. So decline was there in the value of investment, and it was perceived that this decline is of long-term nature. So it transferred an amount equal to decline in the value of both investments from profit to investment fluctuation reserve. Is this treatment correct? So the company were expecting that there will be a decline in the value of investment, and this decline will be a long-term decline because the share market was not doing well, maybe, or the business was not doing well, maybe. So what they did, whatever probability of decline was there, they transferred some amount from P&L statement to investment fluctuation reserve. Is it correct? So answer is, this is the treatment, and this treatment is against the spirit of company's AS rules or Ind AS rules, as the case may be. So when you go to AS, we have AS 13 and AS 1. When we go to Ind AS, we have Ind AS 109 and Ind AS 1. Both are common in that aspect, but they say any reduction in value of current and non-current investments, respectively, should be debited to statement of P&L. Should be debited to statement of P&L. Thus, the decline in value of investment should be charged to statement of P&L, and creation of reserve is not allowed. So you cannot create the reserve against decline in value of investment. Next question, provision for gratuity. There is a company and it has a rule that no gratuity shall be payable to an employee if he or she leaves the service before completion of 5 years. The company believes that no liability should be accrued for gratuity till the first 5 years of an employee. Is this contention correct? The company says we will book no liability towards gratuity payment until 5 years are completed. Is this treatment correct? Yes, any answer? So this treatment is also wrong. If you refer accounting standard 15 or Ind AS 19 regarding employee benefits, both are common in this aspect, but they say, let me show you, although the gratuity benefit may not vest in first 5 years, yet there is a probability that certain employees shall complete 5 years and shall become eligible for gratuity. Merely because a benefit has not vested, it does not mean that the obligation does not exist. The probability concept account for percentage of employees for which benefit will or will not vest. Accordingly, provision should be created during the first 5 years of service. If I say in very simple words, the benefit of gratuity, although becomes payable after 5 years, but the obligation accrues over a period of 5 years. Hence, an entity must estimate the number of employees who will become eligible for gratuity depending upon the attrition percentage across different levels, and accordingly estimate the amount of provision required each year, even if the employees are not eligible for gratuity as on date. So probability concept will be applied, and depending upon the numerical computations which you will be arriving, each year, whatever benefit is getting attributed towards the concerned employees, you have to provide a provision for the same. So the contention of this company is wrong. That is, only after 5 years we will provide for the liability. It is not accepted. Next question. A company is engaged in business of manufacturing and sale of chemicals. The company borrowed funds for purchasing of assets in preceding years. Interest cost on borrowed funds was capitalized in accordance with the laws and regulations till the time of commercial production. So capitalization here means whatever interest cost was there, it was added to the cost of the asset. Later on, after the start of commercial production, no interest was paid to lender because of the financial problems. During the current year, the company repaid the principal amount to the lenders, and as per the arrangement, the lenders waived off the interest which was already capitalized. The company recognized the waived interest as capital reserve. So whatever haircut, whatever deduction, whatever waiver, whatever name you call it. So whatever rebate of this interest, you can say is a layman like a rebate, that waiver, company accounted the same as capital reserve. Is this treatment correct? Can we call this waiver of interest, but the interest which you were supposed to pay, but you never paid it because of the arrangement entered into the system, whether this waiver can be capitalized in capital reserve as equity part? Answer is no. Answer is no. This capital reserve creation is not allowed. Why? Just have a discussion over here. This capital reserve is wrong. Why? The interest waiver cannot be recognized as capital reserve. Instead, the interest that has been capitalized as a part of historical cost of the asset and has subsequently been waived off should be reduced from the fixed asset and accumulated depreciation. The adjustment should be carried out as on the date of waiver. The rationale is that since the asset has been correctly capitalized based on actual cost incurred but subsequently not paid, the capitalized amount of fixed asset should be reduced. This was the opinion given by Expert Advisory Committee of ICAI. So what is the correct answer? Capital reserve cannot be created. Rather, the corresponding fixed asset and depreciation thereon shall be adjusted. Next question. A company is there, Company B Limited, and it is engaged in the business of cigarettes manufacturing. It has several subsidiaries. While preparing consolidated financial statements, B Limited has adjusted the amount of deferred tax asset of one subsidiary with the amount of deferred tax liability of another subsidiary, and the resultant net deferred tax has been disclosed on the face of consolidated balance sheet. The question is, can B Limited do such netting in deferred tax while preparing consolidated financial statements? So deferred tax liability was there in one subsidiary, deferred tax asset was there in other subsidiary. When they consolidated it, what the company did at consolidation level, deferred tax asset of one subsidiary minus deferred tax liability of another subsidiary. Can this netting off be carried out? What's your answer? So primarily, this netting off is not allowed. If you go to company's accounting standard rules, we have AS 22. If you go to Ind AS, we have Ind AS 12. What do they say? An entity is allowed to set off deferred tax assets and deferred tax liability only if there's a legal enforceable right to set off current tax assets and current tax liabilities. And deferred tax assets and deferred tax liabilities relate to taxes on income levied by the same taxation authority. In the given case, B Limited has disclosed net deferred tax after adjusting amount of deferred tax of one subsidiary with deferred tax of another subsidiary. In case there is no legal enforceable right to set off deferred tax asset of one entity against deferred tax liability of another, such netting off cannot be done while preparing consolidated financial statements. Quite obviously, under Indian income tax laws, both subsidiaries are separate legal entities and both are separately assessable. And that's why liability of tax for one entity cannot be adjusted with asset recovery of another entity. And hence, in this question, if I apply the same layman logic, the reporting of deferred tax on net basis by this company B Limited is against the principles of Ind AS 12, or if you go to accounting standards in AS 22. Now, other issue and the last issue is minority interest. Question is, what is minority interest? In companies' accounting standard rules, it is called as minority interest. When it comes to Ind AS, it is called as NCI, non-controlling interest. So what is this minority interest, if I say as a matter of discussion? This minority interest or non-controlling interest represents the equity in a subsidiary which is not attributable to parent. And it arises when parent owns less than 100% of subsidiary. So if company A Limited owns 80% equity share capital of company B Limited, So 80% is parent's equity and that 20% remaining portion is outsider's equity. That outsider is called as minority interest or non-controlling interest. So minority interest or non-controlling interest comprises share capital held by outsiders plus reserves and surplus attributable to outsiders. This minority interest or non-controlling interest, as the case may be, these are the terms respectively used for accounting standards and Ind AS. These minority interests shall be shown separately in consolidated balance sheet. And the share of profit or loss, as the case may be, also shall be separately shown in consolidated P&L. So what you need to understand, this minority interest and non-controlling interest are the accounting concepts only and only for the purposes of consolidated financial statement. I'm not going into operation and mismanagement because this concept there comes as a technical other way around. But when you come to today's leg of discussion for accounting aspects and financial statement aspects, let us confine ourselves to only one thing. This minority interest and non-controlling interest is relevant only for consolidated financial statement. Question arises, please think over it. Can minority interest be negative? Can minority interest be negative? What's your answer? Before I deep dive, let me ask you, can minority interest be negative? Just any answer. Answer is yes. Let us try to understand. So, what is negative minority interest? Assume that the subsidiary has negative net worth. Now, what is negative net worth? Losses are exceeding the equity. So, if subsidiary company has negative net worth, what will happen? Minority will also share in this negative net worth, and that's the reason minority share of losses may exceed their equity stake. Now, question arises, should this negative minority interest be considered as goodwill in consolidated financial statements, or it shall be shown as negative liability? Basically, the question is whether negative minority interest, if it at all it is there, how it will be reflected in consolidated financial statements. Let us take scenarios. Ind AS scenario and accounting standard scenario. So treatment under accounting standard is different. Treatment under Ind AS is different. Up till now, whatever questions we discussed, the treatment was same for accounting standards and Ind AS. Now this different treatment you will be learning. Let us start with accounting standards first. In accounting standard, we have AS 21. Under accounting standard 21, what they say in balance sheet, minority interest cannot be negative. I repeat, in balance sheet, minority interest cannot be negative. AS 21 says excess losses attributable to minority are absorbed by parent's equity. So in consolidated financial statements, whatever negative minority interest is there, that will be deducted from the parent's equity share capital. But minority interest will be nil in such cases in the console balance sheet. In future, when company will start earning profits, that is subsidiary company will start earning profits, the profits shall first be allocated to the parent until the earlier losses are recovered, and balance profits will be attributable to parent and minority in the equal proportion, in the respective proportions. Let us take a numerical example. Suppose that subsidiary's net worth is minus 75. That is 25 rupees of capital minus 100 rupees of losses. So negative net worth is there, that is rupees 75. Let us assume the parent company pays rupees 80 to purchase 60% interest in subsidiary. So that means the parent share is minus 45. So what will be the goodwill? 80 rupees were paid for a negative net worth of minus 45. The goodwill is 125 rupees. What is the minority interest? Minus 30. But this minus 30 will be shown as nil, and it will be deducted from parent's equity in the consolidated balance sheet. So here minus 30 will be shown as nil. But when it comes to Ind AS, we have Ind AS 110 or 1103, both will be read together. What they say, non-controlling interest can be shown negative in consolidated equity, and no absorption by parent will take place. Parent will be responsible only for its own share. And subsequently, when profits will be allocated, they will be allocated in respective proportions. If I give you the example, let us take the same facts. Net worth was negative. minus 75. Parent pays rupees 80 towards 60% share. So what is the goodwill? 125 rupees. Now in this question, negative interest, that is minus 30, will be shown as negative equity attributable to minority in the console balance sheet. So in the previous question, if you see the last bullet point, this minus 30 will not be shown in balance sheet, but in this Ind AS, minus 30 will be shown in balance sheet. So what is the difference coming up? Minority interest, negative figure will not appear in console balance sheet when the company complies with accounting standards. Minus figure of minority interest will come in balance sheet when the company complies with Ind AS. That we need to be very careful about. Now, having understood various issues, let us discuss some elements about reading between the lines of financial statement. Sales manipulation. But we need to understand sales are quite vulnerable to misrepresentation. Common ways of manipulating sales include recording sales before they have actually been earned or making up sales that do not exist. The timing of recognition of sales and expenses is also a key issue. And a classic manipulation is to record deliveries to the agents, to the showrooms, to the dealers, to the storage owners as actual sales. So the goods are sent to agents or warehouse, but the company shows them as sales. It's a manipulation. So one needs to be careful about the revenue recognition principles being followed or not. Other is expense manipulation. So capitalizing expenses refers to spreading the cost of something over multiple reporting periods instead of expensing it entirely in the period in which the expenses are occurring. So one form of manipulation is to deliberately manipulate the way in which expenses are booked. For example, by capitalizing rather than expensing normal operating expenses. So instead of debiting the expenses to P&L, what the company did, they capitalized the expense as an asset in balance sheet. Obviously, profits will be overstated. Other methods include recording current expenses in future period to boost current earnings, or booking future expenses in the current period to create a bottom so that future earnings appear to have increased. These expense manipulation need to be careful about. Then is incorrect asset valuation. Inventory, fixed assets, accounts receivable may be overstated. We have seen examples in today's lecture as well to inflate companies' assets. This may include not recording the full cost of raw materials, not writing of inventory, as I gave the example, the revaluation inventory figures. So not writing of inventory that cannot be sold, or misreporting the current inventory. Failing to record depreciation of fixed assets is also considered as a form of fraud. Hidden liabilities. Manipulating liabilities includes failing to record accounts payable or not including certain liabilities on balance sheet. Complex related party or third party transactions do not usually add value but can be used to conceal debt from the balance sheet. The omission of warranty, it's quite common. Warranty provisions, contingent liabilities. So these product liabilities, they are not disclosed in financial statements. So it could be a way of concealing the potential liabilities or actual debt. Then improper disclosures. For example, misrepresenting the company and making false representations in press releases and other company filings are all referred to as improper disclosures. Some might be intentionally confusing and incomprehensible. Others may involve deliberate dissimulating significant events or management fraud or changing the accounting policy or the auditor. You know, all these things are also considered as material events when it comes to Regulation 30 of SEBI loading. All these things we need to understand whenever we are going into preparation and presentation of financial statements. Let me ask you one question, try to answer this question over here. Say that the company is RST Private Limited. The company received share application money on 15th January 2024 and the money was deposited in a separate bank account. The company balance sheet as on 31st March 2025 reflects share application money pending allotment which was received on 15 January 2024. So this is the basic fact. What you will do, how you will treat this disclosure made by the company on 31st March 2025. What this disclosure should be telling you. So this is something really, I should say, sensitive, and you may find the balance sheet in real world as well. But you need to understand, we have section 42 clause 6, sorry, section 42 subsection 6, companies deposit rules, rule 2, sub rule 1, clause C, sub clause 7. What they say? Share application money shall be allotted within 60 days of its receipt, else refund the same within next 15 days, else it will be treated as deposit. Right? This is the provision. Section 42 says interest at 12% per annum is payable on such refund. And more importantly, this is first part, more importantly, when it comes to section 164 subsection 2 clause B, what it says, for other than government companies, if default is there in repayment of deposits for more than equal to 1 year from the due date, then the directors of such company are disqualified. Right? This is the provision. If you go to this question data again, this share application which is pending allotment had become deemed deposit by virtue of deposit rules. So the matter of fact, and as a financial professional, what you need to check? You need to check whether this share application money pending allotment has been reclassified in the balance sheet as deposit. Number one. Number second, you have to check whether interest at 12% per annum has been provided for in the books of accounts or not. Number three, you have to check this deposit originally was due to be repaid on 31st March 2024, but it was not paid back. So close to 1 year exactly has already been come into picture, has already been invoked. So what will happen? Director disqualification is also attracted. So there are several implications. So as a secretarial auditor or as a company's compliance professional, you need to be careful. If this kind of situation is there, deemed deposit situation, please always check whether section 164(2)B is getting invoked or not on account of deemed deposits becoming due to be repaid for more than equal to 1 year from the due date. If it's there, it may result in disqualification of directors and hence automatic vacation also in section number 167 of Companies Act. So be very careful in these kind of elements. So from my side, this is the deliberation. We have some minutes left with us. I would be happy to answer your questions. I was originally hoping there will be lots of questions, but questions are not coming. Any questions? Survi ma'am, are you there?
Yes, sir.
Ma'am, can you please check the questions if any? Because from my side, what was the topic given to me, I have covered, but I found no questions today.
Sir, actually, you have explained everything in such a detailed manner and with your own questions and replies. So there is no scope left for the members to post their queries. All of their queries are being covered in your presentation only.
Thank you for the
But
compliment, ma'am. But it seems like, as a teacher, if I say on a lighter note, it seems like today being a festive day, it's a kind of a half day class.
yes, sir. I think our members are in the festive mode. So, but still, we have certain questions. So, I would like to pose such questions before you. So, one question is in EPS, is CCPS or any convertible security can be considered?
No, only equity shares, actually allotted equity shares.
Okay, okay. Where to disclose agreed warranty against asset damage and is to realize in next financial year, whereas the damage has already been considered in this.
So if guarantee obligations are there, they will be disclosed in notes to accounts, unless and until they're actually received or settled. So if
Okay,
they're actually received or settled, they will automatically go into the financial statements, as they will appear only in notes to accounts. For this
okay,
purpose, we have accounting standard 29 and Ind AS 37.
okay, okay. So one another question is, please clarify regarding the usage of rounded off figures in the financial statement. In form AOC 4, we have to enter the full figure, but AS mandates for the rounded off figures to hundreds, thousands, lakhs in the
Okay,
signed financial statement. Which amount we should follow or enter?
understood. So what we need to understand, first of all, rounding off is not mandatory under accounting standards. Rounding off is mandatory under Schedule 3. So first of all, we need to correct our usage. The correct usage is rounding off is made mandatory by Schedule 3, note accounting standards and note Ind AS. Number one. Number second, while rounding off of financial statements figures is mandatory under Schedule 3, but when you will file AOC 4 primarily, rounding off is not required. Only for the preparation and presentation of financial statements, duly audited financial statements, rounding off is mandatory. ROC filing, whatever punching figures you are doing in AOC 4, it will be only actual figures. So this is a kind of differential, but yes, we have to follow because this is the position as we are facing today.
Okay. So what are the accounting basics for ESOP being issued to employees?
So for ESOPs, when it comes to accounting standards, we have guidance note on ESOP accounting. Guidance note on ESOP accounting is issued by Institute of Chartered Accountants of India. And when it comes to Ind AS, we have Ind AS 102, share-based payments. So it's a very complicated, I should say, accounting treatment. So whenever time permits, I would suggest to go through the guidance note or Ind AS 102.
Okay. Sir, how to read a balance sheet of a company which has done most of the investment as minority interest?
See, when it comes to minority interest, accounting of minority interest is nothing like a special treatment. Let me take like this. If Surbi ma'am is there and she invests into 100 shares of Reliance Industries Limited, so what will happen in the financial statements of Reliance Industries Limited? She will be a minority shareholder. But in the books of Surbi ma'am, it will be investment in shares of Reliance Industries Limited. So no special treatment. Let us assume Surbi ma'am paid rupees 1,000 to make this investment. What she will do in the balance sheet, one item will be investments in shares of Reliance rupees 1,000. Another item will be cash balance 5,000 minus rupees 1,000 paid to Reliance. So balance sheet will tell you automatically. So no special treatment for minority investment.
Okay. Another question is that we are not consolidating subsidiary in CFS, Consolidated Financial Statement. Is it violation?
If subsidiary is there and it is not consolidated, it will be a contravention.
Okay.
Subsidiary consolidation is mandatory. No exemption is there unless and until Rule 6, Companies Accounts Rules, is provided in the law. If that rule is giving you some kind of a leverage, then obviously consolidation is not required. It is popularly called as intermediary subsidiary exemption. So let us assume we have a ultimate holding company, then subsidiary A, then subsidiary C. If this main holding company is consolidating all the subsidiaries, then this middle subsidiary B, need not consolidate. That is the exemption given by Rule 6, Companies Accounts Rules.
Okay. Sir, is AGM of a subsidiary company needs to be held prior to the AGM of the holding company? The financial statement of subsidiary was already approved by the board of subsidiary company pending adoption in AGM.
This is quite contentious in the real world, but to my understanding, if the board has already approved financial statements of subsidiary, then quite obviously this will be consolidated, and holding company will also consider those consolidated results. Ultimately, subsidiary company AGM, that holding company only will be attending. So in my view, the dates can overlap. There should not be any problem.
Okay. So another question is Gratuity Trust entity a related party to main entity, and should it be disclosed under RPT note?
As far as accounting standard 18 is concerned, it is not a party related, but under Ind AS it is party related.
Okay. Sir, please explain on the consolidation of LLP with company, since consolidation is on body corporate and LLP is a body corporate.
I would also include partnership firm over here. Not only LLP, but partnership firm also. So please understand, when you refer companies AS rules or Ind AS rules, what they say, wherever the word entity is used in AS or Ind AS, it means the companies under Section 2, Clause 20 of the Companies Act or body corporate. Now, question arises whether these body corporates or non-body corporates like partnership firm, they also need to be consolidated if they are my controlling parties. Answer is yes, because accounting moves on substance over form. Even LLP, partnership firm, they will be consolidated.
Okay. Sir, is a company required to prepare consolidated financial statement and file AOC 4 CFS if it has an interest in a joint venture, even when it follows the accounting standard framework, not NDAs?
So when it comes to joint venture, first of all, we need to understand where this joint venture is used in Companies Act. So we have definition of associate, Section 2, Clause 6, Companies Act. That definition of associate includes joint venture. So when you console associate, you also need to console joint venture, provided that joint venture fulfills the definition of associate, that is 20% or more than 20% of the interest. So what I should say the checklist is, first is you must have a joint venture. Second, this joint venture fulfills the conditions of being an associate. In that very sense, it will be consolidated.
Okay. So, sir, now we don't have any more questions by the members. And now I would like to place a formal vote of thanks on the behalf of the Institute of Company Secretaries of India and all the members who have joined this particular session. So, sir, thank you so much for taking out your valuable time in this today's day of festival and expressing your views on this particular and a very technical topic, I must say, which is of utmost importance for all the professionals, finance professionals specifically, to understand. And the nitty-gritties and the depth in which you have explained those nitty-gritties are definitely going to benefit our members and the participants of this session. Thank you so much, sir. Thank you.
Thank you, ma'am. Thank you very much. Thank you, audience. Have a nice day. Thank you.
Thank you.